Hey everyone, welcome back to Corporate Decoder. Today SEESH just filed a Form 8K and I am seeing a big move in their debt issuance that could signal future financial plays. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing tells us about a massive bond offering that Southern California Edison company and its subsidiary are undertaking. It looks like they are raising nearly $2 billion, which is a significant amount of money and tells us they have big plans or needs. Let's dive into what this filing is all about. On the 21st of July 2026, Southern California Edison Company, along with a special company called SCE Recovery Funding, LLC, made a big announcement. They entered into an underwriting agreement, which is basically a contract to sell bonds to a group of banks who will then sell them to investors. We are talking about a huge sum here, $1,953,948,000. That is almost $2 billion in senior secured recovery bonds. Series 2026. I think of these bonds like loans that the company is taking out, but instead of borrowing from one bank, they are borrowing from lots of investors. Now, typically companies will list their stocks on exchanges like the New York Stock Exchange or NASDAQ, and those are the securities bought and sold by everyday investors. However, this section here is interesting because it says none. This means that the specific securities registered under this part of the Exchange Act are not applicable in this particular filing, suggesting these bonds are being issued under different rules or to a specific set of qualified investors, not directly listed on major exchanges like common stock. The main story here is that this filing announces the details of this massive bond sale. It's not just a small issuance, it is nearly $2 billion. This kind of borrowing usually happens for a few key reasons: to fund large projects, to refinance existing debt that might have a higher interest rate, or to manage cash flow during a significant expansion or a period of uncertainty. For Southern California Edison, a big utility company, this kind of capital raise is often tied to infrastructure upgrades, renewable energy projects, or, as the name recovery bonds might suggest, funding for past events like wildfires or other operational challenges that have significant costs. This exhibit here is the actual agreement, the nitty-gritty of how these banks like RBC Capital Markets, Barclays, Citigroup, and JP Morgan are going to help sell these bonds. These underwriters essentially guarantee the sale of the bonds for the issuing company, taking on some risk themselves in exchange for fees. The fact that these major financial institutions are involved signals that this is a significant transaction, not a small under-the-radar deal. This next document, the indenture, is a crucial one. It's the legal contract that governs the terms of the bonds themselves. It lays out everything: how much interest will be paid, when it will be paid, the maturity date, and what happens if the company can't pay. Think of it as the rulebook for this massive loan. The fact they are designated as senior secured means these bondholders have a high priority claim on the company's assets if things go south, making them a relatively less risky investment for those buying them, but also indicating the company is willing to pledge assets to secure this debt. Here we see the operational side of things. The Recovery Property Servicing Agreement indicates that Southern California Edison Company will be responsible for managing the assets or revenue streams that are backing these recovery bonds. This is common in securitization, where specific pools of assets, in this case likely related to energy rate recovery mechanisms, are set aside to pay back bondholders. The company continues to manage these assets, ensuring the income generated is used to service the debt. This agreement shows the transfer of these recovery properties from Southern California Edison to the special purpose entity, South Carolina E-Recovery Funding, LLC. This is a key step in making the bonds secured. The company is essentially selling the rights to future revenue streams related to specific recovery mechanisms to the funding LLC. This legal separation helps protect bondholders, because these assets are technically owned by the LLC, not directly by the parent company, and are earmarked for bond payments. This document is quite important when there are multiple layers of debt or different types of creditors involved. An intercreditor agreement defines the rights and priorities among different lenders or creditors. In this case, it likely clarifies the relationship between any existing debt holders of Southern California Edison and the new senior secured bondholders, as well as potentially other parties involved in the financing structure. It ensures everyone knows their place in the pecking order, especially in a scenario where the company might face financial distress. Now, looking at the signatures, we see Brendan Bond signing on behalf of both Southern California Edison Company and CA Recovery Funding LLC. This dual signature indicates his senior role in treasury and finance for both entities, emphasizing his direct involvement in authorizing this significant debt issuance. The date of the signature, the 23rd of July 2026, is just a few days after the underwriting agreement was signed, showing the speed at which these transactions are moving once an agreement is reached. So, what's the takeaway here? Southern California Edison is raising a colossal amount of money, almost $2 billion, through senior secured recovery bonds. This tells us they are actively managing their capital structure and likely have significant financial obligations or strategic investments on the horizon. The use of a special purpose entity, South Carolina E-Recovery Funding LLC, and the detailed agreements surrounding recovery properties suggest a sophisticated financial structure, potentially designed to address specific cost recoveries or to isolate risk. This isn't just routine debt. The term recovery bonds points towards funding needs related to past events, like regulatory settlements or infrastructure costs. While securing this amount of capital is a testament to the company's access to credit markets, it also means a substantial increase in the company's debt burden. This will certainly be something to watch, as managing this new debt will be key to the company's financial health and its ability to invest in future operations. The risk I am watching is how these recovery bond payments will impact the company's operational flexibility and its ability to fund new growth initiatives in the coming years. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord if you want to talk more.